Many people out there dream of one day owning a home, and of course, once you do actually own a home, then the dream becomes paying off that mortgage and fully owning your home. So of course, the question always arises about what are the best mortgage payoff strategies? With the average age of a first-time home buyer being 32 years old and the average mortgage being 30 years, that pretty much means you'll be extremely close to retiring before you actually fully pay off that mortgage. Now, these ideas are things I'm actually trying myself, or ideas that I've seen other people do before that actually successfully paid off their mortgage in a shorter time frame than normal, approximately about 7 to 10 years. Now, of course, all of these ideas are going to depend on your own current situation, whether or not you have kids, whether or not you're dual income, and the actual expense of your overall home, but hopefully all of these ideas do end up being useful for you. Now, the first bit of advice I want to start with is to make bi-weekly payments, and this won't necessarily work out for everybody because in some mortgages, you actually aren't really allowed to, or there's kind of a penalty to making bi-weekly payments, or at the very least, if you make an additional payment before your actual, main payment is due, it won't actually count towards that initial payment. And what I mean by this is if your mortgage typically ends up being about $1,000 per month, if you make a $500 payment in the middle of the month, you still end up having to owe that full $1,000 by the end of the month. So they actually won't apply it to the actual monthly amount that's due. But if you can apply this strategy, I highly recommend you do so, because not only can you save tens of thousands of dollars over the course of the life of the loan, but on top of that, you can even reduce the life of that mortgage by about 5 years. And the real reason I really like this strategy is because you end up paying the same amount anyways by the end of the year, or even at the end of the month. For example, in that scenario I was talking about, if you pay $500 in the middle of the month and then end up paying $500 at the end of the month, at the end of the year, you still have made, $12,000 worth of payments. Nothing has actually changed, but because you're saving that interest for those 2 weeks that you paid that $500 earlier, and every single time you do that, you're saving on that interest and it begins to accumulate, it can actually end up being a substantial amount of savings. The second strategy to paying off a mortgage quicker, and this takes a little bit of financial discipline, is to, anytime you have a lump sum of amount of money that comes into, your finances, to apply that immediately to your mortgage payment, that principal amount. And what, good scenarios of this would be, if you have an end of the year bonus, or if you have a tax refund, or even a stimulus check that comes in, that a lot of people are hoping for the second one to come in, those are good things to apply to your mortgage principal immediately. And even just one lump sum payment of $5,000 early on in the life of a $200,000 loan can save you $12,000. And you'd pay that mortgage off almost 2 years early. If you had that same bonus every year, you'd end up saving $70,000 in interest and practically cut the life of that loan in half. And obviously this takes a substantial amount of financial discipline, because everybody gets excited about, an end of a year bonus or a tax refund to be able to buy fun things. But what I would challenge here, or at least, kind of as a compromise, is if you aren't willing, or if you're not on board with that idea of, if you have $1,000, end of the year bonus and you're not thrilled about applying that to your mortgage, what you can actually do is kind of make of a compromise and apply a percentage of that to your mortgage. For example, in that scenario, it's giving of a $1,000 bonus, you can apply 75%, so $750 to the principal of your mortgage, and it still leaves $250 to do something fun with. Now, the third tip I would give to everybody out there is to make sure you understand your budget like the back of your hand. And what I mean by this, obviously, if you can cut out dining expenses, and reduce your grocery bills a little bit further, obviously you have more money, so you can apply that to your mortgage. But what I really mean by this is, really understanding where you can actually increase your spending on that principal of your mortgage. You see, I think everybody out there has kind of a target amount for their emergency fund, and then they end up having this leftover that they just kind of apply to savings. And, it kind of ends up fluctuating a little bit, right? Not everything in finances ends up working perfectly. But if I fully understand, where my emergency fund needs to be, what that actual amount is, and how much money I, end up accumulating every single week or every single month, then I know exactly the amount that I can apply, an additional payment to my mortgage to be able to pay it down quicker. But obviously, if you don't understand your budget that well, then it makes it, that much more difficult to do so, because then you become more hesitant to apply an additional payment to your mortgage, and you rather just keep it in a savings account, even though the overall goal, and you would have been, still well off by applying that, additional amount to your mortgage. Now, the next tip in all of this is a little bit more of an extreme example, but that's to downsize your home. And this can end up playing out really well for a lot of people, because the typical American ends up having too much house. And, the square footage year after year always increases for the average household. So it's kind of just proof that we're just kind of accumulating more and more space that we don't necessarily need. And even I'm guilty of this, so I'm not necessarily flawless either. I probably have a house a little bit too big for my household. But, it can end up saving a huge amount, because think about it this way. If you have a $400,000 home and you probably could have, lived pretty comfortably in a $2,000 or $200,000 home, then, and you're still able to make the same amount of payments that you would have on that $400,000 mortgage. So let's just say, for example, to keep the numbers easy, your mortgage payment was $2,000 on that $400,000 home, then when you downsize to that $200,000 home, still make that same $2,000 monthly payment. So that way you end up cutting the lifespan of your loan in half. So the last tip I want to give here is to refinance your mortgage. And there's a lot of variables to consider when you're thinking about refinancing a mortgage. You have to consider about the interest rate that you currently have versus the interest rate that, is on the market right now. And on top of that, you have to care about whether or not you're paying mortgage insurance and whether or not you still would be if you were to refinance, and if there's any kind of special offers or anything available currently. But to keep things fairly simplistic, I'm just going to go ahead and say that your interest rate right now is 5 or 6%. Then by, refinancing to a lower interest rate that's at 3%, now, if you still made that same payment, because the interest rate is not necessarily as high, then in theory, you should be paying more towards your principal, which means not only are you going to be saving, an overall interest expense by the end of your mortgage, but ideally you would be saving a couple of years too on the lifespan of that mortgage. And possibly another scenario where it would be really beneficial is, what I was kind of alluding to before, is if you can remove that mortgage insurance. So for example, if right now my home was valued at $200,000 and I only put down $10,000. But if I were to refinance right now, my home has appreciated, let's just say, something crazy of, appreciated to $300,000. Then I can still refinance, and now I no longer have to pay that mortgage insurance, which in some cases can be, upwards of $100 per month. And like I said, if you just still keep making that same payment though, instead of, now I'm saving $100 more a month and, I can go buy more, groceries or go out to restaurants more often. Don't do that. What you should be doing is applying the same amount of money that you were before to the new refinance mortgage. That's it for the tips that I have, but there's plenty of videos out there that give more in-depth examples, or they have more tips. They have 10, 20 different tips as far as how to pay off a mortgage quicker. But I want to keep things pretty simplistic. But on top of that, I didn't necessarily think that ideas out there as far as have a side hustle and that extra income, apply that to your mortgage, was kind of a fair example or fair tip. Because to me, that's just kind of a completely different scenario, right? If we're making that argument, then why not just make the argument of, win the lottery and use that money to pay off your mortgage faster? So these are things that are really in your control, that are pretty much applicable to anybody that has a home out there, that you can kind of tailor to your own experience, right? You don't necessarily have to refinance right now. Maybe you can refinance 2 years down the road. Maybe the overall goal isn't necessarily to cut the life of your mortgage in half. The goal is just to reduce, your mortgage by 5 years. So hopefully you found this video useful. If you did, please give it a like. And if you like personal finance, business, or economics, please hit the subscribe button. I hope to see you in the next one.